Every year, your money quietly loses value, and most people never notice. It is not a crash, it is not a scandal, it happens in silence. Since 1971, the US dollar has lost over 85% of its purchasing power. The British pound, the Nigerian naira, the Indian rupee, same story, different numbers. This process has a name. It is called inflation. But what most people miss is this. Inflation is not just rising prices, it is a transfer of wealth without a single vote cast. John Maynard Keynes, the most influential economist of the 20th century, once wrote, "By a continuing process of inflation, governments can confiscate secretly and unobserved the wealth of the people." Keynes understood something that most citizens are never taught in school. Inflation does not affect everyone equally. It picks winners and losers. And the selection process has nothing to do with merit, hard work, or talent. It has everything to do with what you own and what you owe. If you hold cash, inflation punishes you. If you hold assets, inflation rewards you. This single mechanism quietly separates the wealthy from everyone else year after year. To understand how inflation transfers wealth, we need to understand what money actually is. Money is not wealth. Money is a claim on wealth, a store of purchasing power. When governments or central banks increase the money supply, more money chases the same goods. Prices rise, and the purchasing power of every existing unit of currency falls. Milton Friedman, Nobel Prize-winning economist, stated it plainly: inflation is always and everywhere a monetary phenomenon, too much money chasing too few goods. Now, here's the key question: who receives the new money first? This concept is called the Cantillon Effect, named after economist Cantillon in the 1700s. Cantillon observed that new money does not enter the economy evenly or all at once. It enters through a specific point, usually banks, financial institutions, or government contractors. Those who receive the new money first can spend it before prices have risen. They buy assets, property, and investments at yesterday's prices. By the time that new money reaches ordinary workers and savers, prices have already adjusted upward. The worker gets the inflation, the asset owner gets the gain. The system was never neutral. Now, let us look at the debt dimension, because this is where it gets even more revealing. Inflation erodes the real value of debt. A loan taken today becomes cheaper to repay tomorrow. If you borrow $1 million today at a fixed rate and inflation runs at 7% annually, in 10 years the real value of that debt has been cut nearly half in terms. Wealthy individuals and corporations know this. They borrow heavily to acquire assets. The assets rise in value with inflation. The debt shrinks in real terms. The gap widens. Meanwhile, the saver who kept cash in the bank watched their purchasing power quietly disappear. As economist Thomas Piketty wrote in Capital in the 21st century, when the rate of return on capital exceeds the rate of economic growth, inequality deepens automatically. Inflation, by lifting asset prices faster than wages, accelerates exactly this dynamic. Let us make this tangible. Consider 3 people: Amara, David, and Wei. Amara is a school teacher. She earns a fixed salary and saves her money in a bank account. David is a mid-level professional. He has a mortgage on a property and a stock portfolio. Wei is a business owner. He holds real estate, equity stakes, and has borrowed to expand his company. Now inflation rises to 8% annually for 5 years. What happens to each of them? Amara's salary increases by 3%, below inflation. Her real income falls every single year. Her savings in the bank earn 2% interest. She is losing 6% in real terms annually. Over 5 years, Amara has effectively lost nearly a quarter of her purchasing power. She saved responsibly and was punished. David's property rises in value alongside inflation. His mortgage debt shrinks in real terms. His stock portfolio benefits as companies pass rising costs to consumers, protecting nominal profits. David did not become smarter or work harder. Inflation simply rewarded his asset ownership. Way's real estate portfolio doubles in nominal value. His fixed-rate business loans become cheaper to repay. His equity in the business rises. He refinances, extracts capital, and acquires more assets. Way accelerated his wealth, not through exceptional output, but through the structure of the system. This is not a hypothetical. This is what happened across the United States, Europe, and emerging markets between 2020 and 2023, when central banks flooded economies with unprecedented liquidity. Global asset prices surged. Billionaire wealth increased by over $5 trillion in 2 years. Meanwhile, real wages for the bottom 50% declined when adjusted for inflation. No law was passed to make this happen. No politician campaigned on transferring wealth upward. It happened automatically through the silent mechanism of monetary expansion and inflation. Housing deserves its own examination because it sits at the center of this wealth transfer. In 1970, the median home in the United States cost roughly 3 times the median annual income. By 2024, that ratio had climbed to over 7 times, and in cities like London or Sydney, even higher. This was not driven by homes becoming more structurally valuable. It was driven by monetary inflation. Those who owned homes before the monetary expansion captured enormous wealth gains. Those who did not, particularly younger generations, found themselves permanently priced out. As economist and author Robert Kiyosaki wrote in Rich Dad, Poor Dad, the rich don't work for money, they acquire assets that produce money and let inflation do the rest. The generational divide in wealth is not primarily about spending habits or financial literacy. It is about who was positioned to benefit from decades of monetary inflation and who was not. One of inflation's most powerful tricks is what economists call the money illusion. When workers receive a 5% wage increase, they feel richer, they celebrate. But if inflation is running at 7%, they are actually 3% poorer in real terms. The nominal number went up, the real purchasing power went down. The worker is deceived by their own paycheck. This illusion has been documented in economic literature for a century. Irving Fisher, the great American economist of the early 20th century, called this one of the most dangerous traps in monetary economics. Workers negotiate in nominal wages. Inflation settles the argument in real terms, silently after the fact. Capital owners, by contrast, hold assets priced in real terms. Inflation cannot fool them the same way. There is one more player in this story that must be examined honestly: the government itself. Governments carry enormous debts, debts measured in nominal currency. Inflation is, from the government's perspective, a highly convenient tool for debt reduction. When a government owes $10 trillion and inflation runs at 5% for a decade, the real burden of that debt shrinks dramatically without any formal default or restructuring. Alan Greenspan, former chairman of the U.S. Federal Reserve, once acknowledged this plainly. Deficit spending is simply a scheme for the confiscation of wealth through the hidden tax of inflation. The word tax is important here. Inflation functions as an invisible tax, but one that was never voted on. It falls heavily on those who hold cash, live on fixed incomes, or lack access to financial markets. Pensioners, low-income workers, and those in developing economies with weak currencies suffer most. Meanwhile, governments inflate their way out of debt, asset owners ride the wave, the system continues. So what does an informed global citizen do with this understanding? The first step is clarity. Recognize that holding cash long-term is not saving, it is a slow, guaranteed loss of purchasing power. Warren Buffett has spoken about this for decades. His mentor, Benjamin Graham, wrote in The Intelligent Investor, "The investor's chief problem, and even his worst enemy, is likely to be himself, especially when he trusts cash alone." Buffett himself has said, "The one thing I will tell you is the worst investment you can have is cash."
This is not an argument for reckless speculation. It is an argument for financial literacy and strategic positioning. The wealthy do not fight inflation. They structure their financial lives to benefit from it. Productive assets, businesses, real estate, equities, commodities tend to preserve or grow real value over time. Understanding this does not require privilege, it requires knowledge, the kind schools rarely teach. Ray Dalio, founder of Bridgewater Associates and one of the world's most studied macro investors, put it this way: "Cash is trash, not because money has no value, but because its value is continuously being eroded by design. The system is not broken. This is how it was built. The question is whether you understand it." Inflation is not a natural disaster. It is a policy choice, with deliberate beneficiaries and deliberate casualties. No one voted for wealth redistribution through monetary policy, but it happens in every inflationary cycle. The antidote is not anger. The antidote is understanding, and then acting on that understanding deliberately. Because in a world where money is constantly being created, the greatest risk is not losing an investment. The greatest risk is standing still, holding paper currency while the world's real assets drift out of reach. This has been Alpha Fiscal Mindset. Study the system, understand the mechanism, build accordingly.